All right, welcome to today's episode of the Australian Lawn and Garden Podcast. We have one of the best guests I could get in one of the worst locations I could ever film anything in the history of the podcast. Good thing no one comes on this podcast to look at my face. I can tell you what. Cait, how are you going?
Hello, I'm good. How are you?
I'm going to give you a bit of an introduction. I'm doing well. I am, for those who are looking at this, they're going, what the heck's going on? We've been wanting to do this podcast for ages, and
Yep.
and things have been happening that just make it like your schedule, my schedule. We book something in, both of us can't. So it's been months, and I wanted to get this done, and it just happens to be that I'm in the caravan park in Mount Gambier, and maybe I'll tell you a story about it later. But I'm going to tell you who you are for those who don't know. You have been working in finance for 8 years. You've done, you tell me you've helped thousands of people with loans, and that would be small business, personal, all sorts of stuff. And you, last year, if I'm correct, you were in the top 5% of finance brokers in the country. Is that right?
That is correct. That you make me sound way better than I actually probably am, but thank you.
That's my job. And
Yeah.
you also happen to be the wife of Cait Bransgrove from Lawns and Good Nick. So you also have an Instagram called Lawns and Good Nick's Wife, which is not as popular as your actual finance Instagram, which is, I was going to say
I'm
serious.
shocked by.
Well, he's doing well. But you're lighthearted, not this is the content. I've never met you in person, but the content's funny, lighthearted, a lot more dancing than you would expect from a finance person. And so anyways,
terrible though.
Terrible dancing.
Yeah.
I'm the same. Yeah. That's my introduction. Welcome to the podcast.
Thanks, Luke. Thank you for having me. I'm excited to be here. I'm definitely the better half of the marriage, so thanks for having me.
No one is ever going to challenge that.
Nick, he probably won't. Let's be honest.
No. Although, I have to be honest, you downgraded yourself about, I'd say, 20 percentage points by buying Gary, the cat.
Luke, Gary's my best friend. Nick, I'm still convincing Gary was a good idea to get, but I just woke up one day and decided I was a cat person, and Nick's not on board, and it's been 3 months. But anyway,
I don't think he ever will be. I think there's this deep, sort of primal instinct that you're for or against cats, and it's unchangeable. So
sure. Nah,
Gary's
the best. You wait till you meet him.
Okay. Part of this as well is this is a secret for those who don't know. We haven't told Nick that this podcast is happening, and I'm just going to release this podcast, and I'm hoping I can get it done before I'm in Melbourne, and I can see Nick's face when he realizes that his wife is a guest on the best podcast on planet Earth, as rated by my own mother. So let's talk about finance. Most people who listen to this podcast are small business owners, and finance is something that gets people very, what's the word? It's controversial. Some people are like, you should never get finance, and some people are like, what are you doing if you don't get finance? And I thought, look, let's get someone on who does this. Obviously, there's on that argument of for or against, there's going to be some level of incentive for a broker to say, yes, you should get finance. But also, there's a lot of people who've used it very, very well. And so we're going to talk about some pitfalls, going to talk about some people who've done it well. But to start with, how did you get into this industry, and how did you get to the point where you're doing top 5% of deals in the country, if that's the right way to present it? What's your career story?
Yeah, so I was working as just a project manager when I was like 19 for a company. Pre that, I was working at Coles, and I, checkout chick, loved it, talked to everyone and anyone. And then I left Coles and I just was a project developer manager for this company. I got really sick and I stopped working, and my mum owned a financial planning company, and mum had been begging me since I was about 14 to go and work for her. But I was like, Mum, that's so lame. Like, I don't want to work for
Yeah.
you. And then I got really sick, and Mum's like, just come and work for me. You can come in when you can. Like, don't have to worry about anything. And so I started working there just in admin. I didn't really know what I wanted to be or do. And when I was working for Mum, she was only doing maybe one mortgage a month. So she was mainly a financial planner, but having those type of clients, obviously some of them wanted, mortgages and finance and stuff for property. And so I started kind of noticing, I was really fascinated by, what did the valuation on the property come back at, or did they end up getting that asset or getting that house or whatever it might have been at the time. And so I just kind of said to Mum, I think I want to study like to be a mortgage broker. And so I started doing my studies. And then I was probably about 22 or so, and I this is really lame, but I launched a marketing campaign called First Home Coach on the couch, and I dressed up in like a Hawaiian shirt, and I sat on this couch I got off Marketplace for about $100, and
Yeah.
I just filmed educational videos on finance, but I tried to make it obviously engaging because finance can be boring as hell. And
Boring. Yeah.
so, yeah,
Lame.
boring. Yeah, so I started filming it, and it got media attention. I was in like the newspaper, and anyway, and so kind of just went from there. I started to get a little bit of a name for myself, and I realized that I wanted to probably start up my own like mortgage broking job, like a company. Was with Nick at this time, and I actually was pregnant with Ollie. So I was 23. I was pregnant with Ollie, and I decided that when Ollie was 4 months old was a really good time to start up my business. So Nick actually
Yeah.
used to be a teacher, and so we were relying on his income. It was stable, and I was like, all right, I'm going to go and start up my own thing, and yeah, it just went from there.
So 23, starting your own business, doing it in finance. When do you remember your first loan that you did? Of course you do. The first loan you
Yeah,
did under your own business.
yeah.
Was it something significant or just something small and silly, or what was it?
It was a first home buyer purchasing, and it was, I think they were buying for like 550,000. And I still remember my like getting the phone call. I was driving home from work to back to Nick and Ollie, and I got the phone call from the bank that they were approved. And I still remember the exact spot I pulled over to call the clients. And I'm like, guess what? And I was like freaking out. They're freaking out. I think I was
Awesome.
more excited than they were. Yeah, I do remember it. But yeah, first home buyer, it was so special because obviously helping them achieve that. And then it just went from there.
And back, how many years ago was this? That that
So I
that
was
moment happened?
23. I'm 28 now.
So 5 years ago, and that house is probably worth 6 billion
Mm.
now, just with the way it's gone. So
Yeah.
great
Yeah, something
financial
like
move
that.
for them. Doesn't matter where they bought or where it is.
Nah, it just worked well. That's all that matters.
That's one of the things as
Yeah.
well. Like people get scared about finance sometimes, and sometimes people are
Yeah.
way too keen about finance. But some people who sit in the middle there and they've got a wise perspective on it, they can really use the loan to leverage, especially with properties. And properties are non-controversial. That's not the controversial stuff about it. It's the business stuff, at least in the worlds
Yeah.
that I travel in. So, do you
Yeah.
remember a time where somebody came to you and I don't need to know personal details or anything like that, but they were asking you for an insane amount of money for a loan and it happened and you were like, what the heck? Because if you're doing small business stuff or you're doing home
Yeah.
loans, maybe $1 million or something like that might be fairly normal for a house. Is there a moment
Mm.
like that stuck out for you?
Yeah, I have one. So we're obviously not financial planners. We can give general advice, and we'll really link someone. So obviously been doing it for a while and been around financial planners and whatnot a lot. We can kind of identify when potentially something's not a great idea, and we'll really steer someone to go and get the advice from where they might need to. So whether it's an accountant or a financial planner. But this was just for a car. So I guess not, this isn't business finance as such, but it was an 18-year-old that wanted a loan to go out and get a Land Cruiser that was, I can't remember the price, but it was a lot at the time. And I remember they came and I easily could have gotten them the finance. Like they had enough income to get it and whatnot. But I like sat them down
Yeah.
and I said to him, I don't think it's a good idea. I think, you're 19. Do you really want to get a debt this large? spoke about depreciation, so the value of the car going down and blah blah blah. And he thanked me. He's still like, it was even a couple of years later, he came back and he's like, thank you so much for not letting me buy that car, because I absolutely would have. All my mates were doing similar. I didn't know any different. I would have gotten the asset. And instead he bought something that was far less, that did him well.
Yeah.
But yeah, it wasn't financial advice. I just told him kind of personally, do you think this is a good decision? Told him who to speak to as well. And yeah, he didn't do it. And he's so grateful.
Do you get that a lot, where people are coming to you and, there's a feeling in your gut where you're like, oh, I'm not so sure about this? Or is it that people are mostly fairly common sense and the vast majority of them have really thought it through quite smartly?
No, I would say most don't, because we're not taught this stuff in school. So we're not taught
Right.
what's a good financial decision, or what's a credit score, and we can get into all of those things, or what to make sure of and not make sure of. People just go, oh, that looks good, like I'm going to get it. And some people perfectly fine. We had someone recently that was almost $200,000 loan for some equipment finance for their company. Amazing. They needed it. Perfect. Wonders. If that was somebody else, though, that might not have been a great decision. So yeah, we do get it a lot, and a lot of people don't know.
And what makes the difference between, in your eyes, is there a way to summarize, like, this is a good loan and this is a bad loan? I guess maybe I'm asking a very technical question there, but like, are there some red flags that you see straight away and you're like, and someone's thinking about, this is why you should avoid getting finance?
It is a hard one, because it is very case by case. Not necessarily. It's more, we'll really talk to the client to try and understand why they need it. And obviously, being self-employed as well and dealing with a lot of business owners, I like to really go into the, like, is this right now the best decision for your business, or is it actually better to have the cash flow or the money going towards something else to help grow your business, if that's your goal? So we try and unpack it from that angle. So it's hard to know if it's good or bad.
I guess there's some people who'd come to you and they're trying to get finance because things aren't going well, right? And they need the money to, and I guess there's they're putting their eggs in one basket for, this solution is going to solve all my problems. I'm going to get myself into debt to solve the problem. Like that would be pretty shaky ground, I guess, a lot of the time, right?
Yeah, but also banks are pretty smart. So banks won't necessarily give finance if they can see it's not for a great reason. In saying that, though, and a type of finance that a lot of business owners can get is called low doc lending. And low doc lending is basically, if you have an ABN that's been registered for X amount of time, usually a year plus, and especially if you're GST registered, that shows you're obviously earning over a certain amount. A lot of banks, you can just kind of declare what your income is and they'll lend you the money if this is for asset finance mainly. So it's a bit grey, because somebody who, might not be doing so well and is trying to build, maybe they want equipment to go and try and build the business. And that's where we will try and identify it. But at the end of the day, if they declare it and the bank will lend to it as well, then there are ways to get finance quite easily.
So let's say I'm going to put myself in as a fake character here, and I want to see what it's like. Let's say I'm a small business owner, because I think a lot of the small business owners who are listening to this, a lot of them will be solo. They're earning somewhere between, say, $100,000 turnover. That's not necessarily profit, and maybe $200,000 to $250,000, depending on how long they've been in business, what sort of equipment they're using. Ride-ons or whatever would be high hourly rate. But more expenses. Normal gardening would be typically lower, especially someone starting out. So let's just say I'm in the middle there. I'm about 150. I'm doing $3,000 a week. And I wanted to come to you to get a $50,000 loan. Would there be a difference between, let's say this, I'll give you three options. One would be a truck, right? So a small, $50,000. That's not a very, I don't think you can get a truck for that anymore. But I did back in the day. Oh, actually, let's do that. Let's go a secondhand truck. A brand new ute, right? and a brand new ride-on lawnmower, because there are some that are around that $50,000 mark, is
Yeah.
there going to be a different process for those three
Mhm.
pieces of equipment, even though
Mhm.
they're the same amount of money?
Yes. So different lenders lend depending also on what the asset type is. So equipment finance, which essentially they can all kind of fall into that category, but especially the lawnmower, for instance, it can depend on how old the item is that somebody's buying as to which lenders are going to look at it. It can depend on, and then those things can impact what the interest rate is going to be, which then might impact how much someone can borrow. So there is kind of a follow-on effect, but not necessarily. I mean, most of the time, same thing. If you've got a piece of equipment that is for the purpose of a business, and if we have an invoice, so it's drawn up, it's not just an unsecured, which means you're going to get money to spend it on whatever, then as long as we can do it that way, that's where we can go down that low doc lending, which is where basically you go through the lender that will lend to it. You provide very little detail. And as long as it looks like you can borrow enough, you can get the finance. So, no, it sounds like it's all going to be similar because of the fact we have a secured item we can lend against.
What sort of deposit is typical, and can you get to a point where
Mhm.
you're not paying any deposit at all?
Yeah, super common. Most people don't pay deposits. As long as you can borrow it, you don't need to pay a deposit on it. Sometimes if the item's too old, so again, banks are still looking at it that is this more risk because it's a really old item that you might need another one again soon or whatever, depending on what it might be. But yeah, no, it doesn't necessarily matter either.
All right, that's interesting. If you had a second-hand piece of equipment as well, like I had this challenge once. I bought a
Mhm.
mower that was very low hours, but it was very old in terms of years,
Mm. Mm.
and so the use of it was not very at risk because it had really just been sitting
Mm.
around a shed. But on
Yeah.
paper, it didn't look very attractive because it was a 10-year-old mower for the
Yeah.
finance, and it was a way more difficult for us to get a finance on that, even though it wasn't like a
Mm.
crazy amount of money. But
Mm.
it was, well, not crazy. It was $27,000, I think, is
Yeah.
what we were
Yeah.
getting on it or something like that. We got it in the end, but the
Mm.
first thing I said to my broker when I was on the phone, he was like, "Oh, how old's the mower?" And as soon as I said 10 years, he was like, "Oh, yeah, that does make things more
Yeah.
challenging."
Yeah. Yeah.
What what sort
It
of
is.
limit is there when someone's thinking about this? Because I think a lot of people, especially
Mm.
if they're starting out and they're wanting to get into that type of work, because
Mm.
this mower that we were getting at was typically in the mid 50s, right? If they're trying to
Yeah.
get into that type of work, is there a limit there when they're looking at items just to know, okay, really it should be, let's say 3 years old or 5 years or whatever it is when you're
Mm.
looking at that sort of stuff?
Just think of it that I say to clients, nothing's necessarily impossible, but the older something is, the more expensive it's going to cost you to get that item. So going on to unsecured and secured lending. So secured, yeah, that's where you've got the item. So you've got the truck you want to get, or you've got the exact car or whatever it is. So it's secured, that the money you're getting is secured against a particular debt. Your interest rates and the cost of that loan to get is going to be a lot more affordable compared to unsecured, which is basically like, hey, here's the money and you can go and spend it on what you like. And now, because of that, that's sometimes where these items that are a lot older, we have to go down that unsecured. So
Sure.
it's kind of, here's your 50 grand, you can go and get it, but we don't really want to know you. I love that there was that tractor behind you just
There's a
driving
bobcat
away.
behind us.
There
I
was.
might tell this. I'll tell the story sometime. I mean, we're in the finance talk now. I'll tell the
Yeah,
story
yeah,
of this crazy caravan
yeah.
park at some stage in this podcast.
But yeah, so no, unsecured lending is super popular sometimes because yeah, we do get businesses that can't afford necessarily to buy something that's newer because of the fact that they don't have the money to be able to. So they have to get something a little bit older, which can they still get the finance? Most likely, yes. Obviously, it depends still on the situation, but it just might cost them a little bit more to get that.
Yeah, our challenge was at the time there was a 1 year
Mm,
wait. This is during COVID. It was a 1 year wait for those machines,
yeah,
and so it was like
yeah,
they didn't exist new, and so you had to go buy
mm,
something secondhand. And I
yeah,
guess well, actually, having spoken to, I was speak. I was at Adelaide Oval the other day, and they
mm,
had an item that they ordered 2 years ago that they still haven't gotten yet. Yeah,
wow,
specialized
that's
specialized
insane.
pieces of turf equipment. Some the ones that are
Yeah.
like not as
Mhm.
popular, way less production. Some of them are still difficult
Yeah,
for people to get, which is crazy, really. It's years
that's
since,
hard.
the height of COVID now. So when
Yeah,
people
I'm
come to you,
surprised.
when people come to you as small business owners, what is the number
Mhm.
one thing that you wish they did that would make their
Yeah.
life easier to get a loan?
Yeah, okay, good question. So one is have a good accountant. So there's a couple of things. I know you said the number one, but it's hard to put them all into
Oh,
one.
the more the better.
Yeah, so have a really good accountant because a good accountant can make or break your chances of getting finance as well. So I've sort of touched on that low doc lending, which is more like declaring your income. Now, if you want full doc lending, which is where you're giving full documentation, so it might be tax returns, financials, whatever your situation is. Sometimes the more information you can give, the more competitive the interest rate is also going to be. Again, it's all
Hmm.
about risk for banks. So the more they can see, the better in most cases. So if you are writing all your income off, so let's say your story before about 150,000 turnover, but what is super common is your turnover might be 150, but you might not want to pay much tax. And so your
Hmm.
income's written down really low to whatever, 30,000. That 30,000 then, if we're going for full doc, is the figure. Maybe there's things we can add back, but ignore that. That 30,000 is the figure of what the banks are going to look like at as your income.
Yeah.
So now you don't have that much money, even though you might, but yes, you might have worked on a tax strategy with your accountant, which might have been really good, but have you actually impacted your buying potential over here that you actually really needed to put yourself in a situation for your business that was going to be beneficial? So you have to link in a really good accountant that understands your overall plans, not just, yeah, here's, the way to pay less tax. It's about what's your actual goal right now.
If someone's taking a lot of cash and they're not
Mm,
declaring that as well, is that going to have the same effect?
doesn't exist. Banks don't know it exists. So cash is like nothing to banks. So yes, we get that a lot where people are doing cashies, which might be really great. You've got the cash to go and buy something, but then finance, it just doesn't exist, basically.
Yeah. What is the most common mistake you're seeing small businesses make that's,
Hmm.
I guess, to do with how they think about money? Because you're saying obviously you want to get
Yeah.
a good account and have a good record, but
Yeah.
how are they thinking about things that's wrong?
Okay, so I would say a lot of people that are self-employed, when it comes to managing their finances, and this is obviously general advice, but when they are managing their finances, they don't actually understand all of their expenses. So it could be things like paying tax and when it's due and
Yep.
what money needs to go where. I say when you first start up, which people listening to this, you can absolutely still do this now, even if you're 5, 10 years into your business, is sitting down with your accountant, or if you've got a financial plan, or even if you don't, and doing kind of like I call it a bank account audit. So audit your bank account for all the money out of your business you might have spent over the last 3 months, and actually go through your expenses to understand them, and open up maybe different bank accounts. So you might have one bank account where all your money comes in, but you've got another bank account where, let's say, your tax rate is 27%, you're putting aside 20% of your earnings into your tax account and basically acting like it doesn't exist. Because what
Yeah.
we see a lot is small businesses rack up an ATO debt. Banks hate ATO debts most of the time, and
Yeah.
it probably could have been avoided, but it had to be avoided back at step one, not necessarily now when they're on a payment plan.
Yeah. And that is pretty common. If someone gets on a payment plan, is
Mm-hmm.
that so? Let's say you had, I don't know, let's pull out a number. Say
Mm-hmm.
someone had $15,000 in ATO debt
Mm-hmm.
off a payment plan versus on a payment plan. Does that make a difference with the ability to get a
Yeah.
loan?
Um, I would say on a payment plan is most of the time more beneficial. Banks don't love ATO debt because they do see that as one of like the overarching, if you're not paying that, then are you going to pay us? Sort of is
Yeah.
probably the easiest way to put it. Um, it's hard to say. I mean, at the end of the day, if you can prove you're paying off debts, that's what banks are going to want to know. So I guess to answer your question, if it was me, I would probably want to go on an ATO payment plan rather than just not tackling the issue. But they'll probably make you tackle the issue anyway. You can't get away with it forever. So not the end of the world. Like people listening going, oh shit, I've got an ATO debt. Like I can never get finance. That's not the case. It's just harder. And again, it's more expensive. So the better you can set yourself up, the better you're going to be in a financial position for loans.
Is there a point where the ATO debt's going to get so big that, it is just going to completely stop the ability to get a loan? Like, if we're talking a reasonable amount, like let's say $10,000 or $15,000 for a business, that's not insane. But if we're in the hundreds of thousands, is that going to get to a point where they're like, what are we doing here? We're not even going to look at that sort of person.
If you're on a payment plan, no, I would say. So I've dealt with someone before that had a 200,000 plus debt for the ATO, and they were on a payment plan proving they were going to pay it off over X amount of years. And so that was just taken into account as a debt repayment that they had, although not great. But there's some lenders that will also lend to you to pay off your ATO debt. So sometimes the strategy might be, okay, our goal is to get to here, but the only way to get to that is we need to pay this off. Let's pay that off by going and getting this loan. So there's always a way. It's not always, sorry, I guess sometimes it's you hit kind of a wall for a bit. Yeah.
But you can be optimistic, and you can be like, if you really gotten yourself into a hole, and I don't know how many small business owners, especially with solo, are going to get to that sort of point. But it's interesting.
Yeah, I hope not.
To know. Yeah, I certainly hope not too. And if you're going to get a debt, why do it half-hearted? $1 million, go for it. You know what I mean?
Yeah, just go for it. The other thing we see a lot.
That's a joke, people. Don't sue me.
Yeah, please don't. Please don't. Add me.
Yeah.
The other one we see a lot is credit scores. So for those that don't know, a credit score is a ranking from -200 up to 1200, and it basically says how good you are with debts if you've got debts and paying them on time. General rule of thumb with a lot of lenders, if you're trying to get the more competitive rates or get finance, and this also is in like residential lending, commercial lending as well, is you want a credit score of 650 or above. It's kind of a general rule. Now, the only way to get a credit score and generate one in the first place is you have to have either some type of debt, or it could be from like having utility bills or a phone plan. They're common ones. You don't have to have a credit score to get finance, though. It's some banks, yes, but it's more a myth from America, because in America you do have to have one. Yeah. So
I have no idea what
credit scores are a big one. No, and I probably can guarantee 99%, listening would have absolutely no idea. I go and look at your credit score, because what we see sometimes is people might have been hacked and they've got all these things being used or debts being applied for they didn't even know. We see that far more often. And if your credit score is damaged, things that go on your credit report are on there for 5 years. So if you make an error and it's not great, it's going to show up on your credit report for 5 years. And your credit report is almost like the Bible for the bank, that they're going to look at that and they're going to judge you and see if you're good at paying back debts or not. So if you haven't looked at your credit report before, go and look at it. A site you can use is Equifax, so EQUIFAX, and you can download a free report once a year. Or like Ilion, they're ones like that. Sometimes people ask if that can damage your score checking. If you check with the normal main majors, no. There's some random like other ones I won't say, but check your credit score.
I had this time once where would this affect my credit score? I moved house, and I can't remember what happened. But I think we had an automatic transfer or something that ended or something like that. But I moved house. Yeah. I didn't update the lender, and I think I had like a $300 a month or something like that loan, and so not very big, $60 a week or whatever it was, and I missed 3 payments on it, and they were sending me these letters to the wrong address. And I remember it was because such a weird phone call. I got a phone call from this guy, and he called me up. He was like, "Hey, I'm such and such from this loan place." And he was very awkward and tentative in his wording. I knew exactly where he was from. And I was like, "Yeah, Nate, how you going?" Like, like and I'm oblivious
Just ready to have a chat.
to the fact that I'm just happy and whatever. And he's calling up thinking we're trying to avoid paying money, and he's going to have this really tense, awkward conversation with somebody about paying back a debt. And I was like, yeah, how you going, man? He's like, are you aware that he said something about the letter that we had just sent or something like that. And I was like, no, I haven't. Sorry, man, I've changed addresses. And he's like, oh, okay. And then he goes, well, you are. And I was like, oh, do I? And then we just pay. I was like, oh, I'll pay it this afternoon.
Yeah.
And then his whole temperament changed and everything. Because anyway, he was expecting this really awkward. Anyways, I've done that. I had several problems over the years, not with loans, but I also once let my car lapse and got pulled over by the police because I changed my address. I know. I had to take my car through the pits. They pulled me over, and they were like, do you know why we've pulled you over? And I was like, I've got no idea. This is when I was young. And I was like, no, I've got no idea. And I was like, you're driving an unregistered vehicle. And I was like, what? And I'd moved house, and I hadn't. Anyways, that's just my own personal problems. But would something like that show up on a credit score thing?
Yeah, so depending on the lender, which most lenders will show up on credit reports if you've gone and got a debt with them or even inquired for a debt with them. If you miss repayments, it will show up on your credit report for up to 5 years. So you usually get a grace period. You get about 30 days or up to 60 days with some lenders that if you don't make a payment, they'll kind of maybe let you off. It's just a little blip in the system. But if you consistently, and so 1 month plus 2 plus 3 are missing payments, it comes up as a little number on your credit report to show you are 1 month behind or 2 months behind or 3 months behind. And that can then impact your credit score. Yes. The way to then rebuild your credit score, though, is to basically just then you're showing you paid things on time and it was just a once off. It's not a pattern.
So if we had... say we did that with a loan that was $2,000 a month versus a loan that was $300 a month, and I had the same mistake. Now, I would have noticed if it was that much, you know what I mean?
Yeah.
You'd notice that much not going out of the account. But let's say that happened. Would you, would that affect it? I'm assuming that would affect the score much more than a smaller loan, right?
Yeah, it's more about, I would say if I had a kind of rule book on credit reporting and knew everything, I don't think even the credit reporting companies know, because your credit score can drop because you change addresses too often or you change jobs too often.
Really?
Because it shows like instability. I think it's so stupid. If you change, some people have to change jobs or addresses, but they base it off, it shows a form of instability with your situation, which could impact your credit. Blah, blah, blah. So same with the size of the loan. Most of the time, it just is if you've made the repayment or not. From a lending point of view, if you're missing a repayment on a debt that's a lot smaller rather than larger, we can tend to argue it a lot more, and banks will be a little bit more lenient as opposed to if it is a larger debt that you're missing. So it's, yes, if you're, long story short, I answered that very long. Yeah, it would make
No, it's good. Now, I've realized that, how these, I forgot to pay these payments. I once have another stupid story on the opposite end. I had a phone plan with Telstra, and Telstra, for some really, really dumb reason at the time, they wouldn't send out invoices via, email. They would send them as letters. And there had been moments where I hadn't opened the letters because, who does letters? This is years ago now. This may be 5 years ago. And I wasn't opening their letters. And so then I just randomly, my phone wouldn't make calls. And I'd be like, oh my goodness, I've forgotten to pay. So what I did, Cait, is I was like, I'm just going to set up an automatic payment, right? And in my, again, lack of organization, I accidentally set up a payment to be fortnightly instead of monthly. So I was double paying them, right? And then what happened is I get all these letters from Telstra being like, you're in credit, right? And because I thought that they were like receipts for my payment, I threw them all out for like a year and a half. And then I just kept getting, and then I got like an urgent one, right, which was different. And I was like, what's this? And I opened it and they were like, we owe you almost $2,000. And I was like, what? And I looked back and I'd been paying, I can't remember. And it wasn't just one phone. We had employees. So it was multiple phones. There was all this sort of stuff going on. So people were like, how do you break up? I literally went into credit and they paid me back. Does that fix my credit rating? No. See,
No, it doesn't.
bloody
Not at all.
one-sided idiots.
That's funny. No, it doesn't at all. I love that though. At least that was a nice like money win. Did you
It
save the
was.
$2,000 or spent it?
What did I do with it? I don't even remember. No, it's
Gave it back to Optus or something.
at the same time as well. I was getting paid in checks by somebody, and I just kept. We had a workers'
Check.
compensation. Yeah, this is weird. At exactly
Wow.
the same time, like within a month of each other, I'd made two
Mm.
disorganized but positive financial moves. In that, we had a workers' compensation claim in terms of somebody else had been injured, and we were doing their gardening as part of the claim, and the insurance paid us in checks. And I was like, I can't be stuffed banking these individually. We knew it was for 6 months. And I was like, at the end of the 6 months, I'm going to go take all my checks. And anyway, what ended up happening is I had more money than I expected in that too. So I got this $1,700, and I think I got another $1,500 in these checks. I was like, I'm rich.
I love that. You're rich. Retire. Is that when you gave
the
up business?
KFC drive-through is not going to know it's going to hit it. So, anyway, so. But it is annoying that my disorganization positively and negatively don't balance each other out.
They don't. No, it's banks. What do we expect?
No, exactly.
Or like credit reporting. But yes, credit scores highly important. Same thing when you're getting loans, when you're a small business owner or business owner in general, is that your credit score, if it's really low, it can completely impact your chances of getting finance. So when I said before, most of the time we can get finance for people. If you're bankrupt or you've got a Part 9 debt agreement, all these certain things that will show on your credit report, they're things that banks will just go, we don't care how much income you declare. A lot of them are going to rule you out to even be lent to.
So bankrupt Part 9 credit agreement. I mean, I know bankrupt debt agreement. I know what bankrupt is from a what's the word? TV movies or something on the news. What does it mean when somebody goes bankrupt?
Yeah, bankrupt is like basically you fully declare you cannot pay anything back, but you don't have to pay it back most of the time anyway. You don't have to pay anything back that you might owe, but it is like an absolute black mark on your credit. So you cannot then do anything for 5 to 7+ years, I think it is. So bankrupt.
It's in taking finance.
Financially. Yeah. I've heard stories before where people go, oh, well, I'm just going to declare bankruptcy. I don't want anything for that long anyway. And I'm like, whoo, I wouldn't do that.
Gee, of a small amount of money or really large amounts of money? I mean, I guess it's all relative, isn't it? Depending on what you earn.
Yeah, it is. Yeah. If you can't pay it and it's damaging your scores and blah, blah, blah. Some people, sadly, we see people in a position they have no choice but to go and declare bankruptcy. But yeah, it's also, we've seen people that have gone through divorces and they've been left with debts and stuff they couldn't pay and they've had no choice. And so there's really, really sad ones, which are upsetting. And we've had some that when they come out the other side, it's very, very rewarding.
What was that debt agreement thing that you said?
A Part 9 debt agreement.
Debt agreement?
Yeah, that Breaking Bad. It's basically where you go into an agreement to pay back a debt, but it's like at the point where it's like not good on your credit report. That's the simplest way to put it. So
how would somebody get into a position like that? I'm guessing this is not ATO debt. This is like a house, or is there anything else?
Yeah. It's a debt collector. So basically a debt collector has contacted you and has said you're not paying your debts back at all. And it can depend on the bank. So some banks don't want to get to that stage either, though. They want people, it costs them money too, right? So yeah, sometimes a lot of lenders, people don't realize this, but have a conversation with the lender and you might actually be able to come to an agreement as well without having to get to this point where it could be really damaging. People just run away from it instead of trying to face it. But a lot of lenders have got almost like hardship lines that you can speak to, some which will still damage your credit, but some might not be as damaging on your credit. It just depends on somebody's position. So if you're a small business owner or you're a business owner, though, it can be important to have good credit because, your business could change a lot over the next 5 years and you suddenly need it and you might not think it today, but you do then. So I always say plan ahead. Position yourself that you want to get debt if you do.
Yeah, okay. Because I guess when you're talking about hardship, I guess a lot of people, and this is my story as well, like you get a health crisis out of the blue or a family crisis or,
Mhm.
whatever it is. Somebody might come in, let's say, you know, you're not insured and somebody steals a bunch of
Mhm.
stuff and you need that money instantly. I guess that's
Mhm.
where, and this is where my problem was when I was trying to get
Yes.
finance. I told you very briefly before we started recording is that I didn't get finance for 6 years in the business
Yeah.
because I was always making enough money. And then what happened is when my health started going downhill, we needed to rapidly grow the business. And then I was like,
Mm.
oh, well, now's a good time to um, help my cash flow. So, let's say you had, let's use some nice
Mm.
round numbers here. Let's say you had $50,000 in the bank and you need to buy a ute and a trailer and everything, and that was going to cost you $50,000. Well, if you spend all your money on the cash, yeah, you're not paying interest. But what happens when a rainy day comes? And so,
Mhm.
that's a great way to use finance if you want to grow it and you're going
Mm.
to use the equipment, not just sit around and do nothing with it. And so
Yeah.
we wanted to go to the bank and having never owned a home and having
Mhm.
never actually gotten a loan for anything, it was actually
Mhm.
difficult for us to
Mhm.
apparently, not, I mean, we got loans in the end,
Yeah.
but it would have been easier to
Mm.
apparently, like, I don't know very much about this. It all got
It
sorted
is
out in the
true.
end. But yeah,
Yeah.
in that sort of situation, what I'm talking about is people having that kind
Mm.
of. Hold on a second. No, we're recording something. No worries. Thanks, guys. Somebody asked if I'm a DJ. Um,
Just start
uh,
spinning some decks for me.
yeah. Do you want me to sing?
Yeah, go for it.
And cutting to the next part. No. Well, so anyway, so the story I was trying to tell is that I didn't know anything about finance because I never really thought about it. I never really looked into it because I never really needed it. And all of a sudden I needed it. And I
Mm.
think what you're saying is true because I hadn't thought about it. And I'd always thought, I don't really need finance, only for a home loan or something like that.
Mm.
It made it more difficult because I hadn't been
Mm.
pre-planning. So anyway, that's a story that is only
Mm.
going to affect a small amount of people because hopefully nobody else
Mm.
listening to this loses the ability to work physically. But if you did and
Yeah.
you had prepared for it, you would put yourself in a bad position.
Yeah, it is true though. It's true that if you do own a home, and like I said before, some banks know you don't need a credit score, but some banks you do. So it's a bit more common in the asset finance space rather than like the resi lending space that having some form of credit can help prove certain things, not for all banks. And yes, being asset backed, so having property will always be will always help far more than anything else to be able to get you more finance. That's actually is very true. But as you said, you obviously ended up still being able to get it. You can. It's just again might cost you a little bit more.
Yeah, I think it was the longevity in the business, and like I think we did have
Yeah.
assets, and we didn't owe anything
Mm.
at all, and there was other things that was going for us. But if I remember correctly, my broker had been like, if you just gotten a loan for something $5,000 or something that you bought outright in cash and had paid it off 3 years ago,
Mm.
you would pay it a little bit more in finance, but it just would have had some sort of history. So, anyways,
Mm.
I'm not, again, neither of us are giving financial advice. Everyone can tell that I'm not even
Yeah.
remembering this story. It's detailed as what it is. But it might be worthwhile for people to actually go and pursue that because that was a weird, slightly
Mm.
problematic issue that I had some years ago
Yeah.
now.
Yeah.
I
Yeah.
want to ask you, let's say this will be quite common. Let's say someone's saving up for a
Yeah.
house and they've
Yeah.
got an old work ute and they're getting a little bit nervous about their work ute breaking down. Let's say, again, let's use $50,000
Mm.
as a nice round number. And so it's
Mm.
not quite where they need to be to get a deposit for the house that they want. They're getting
Yeah.
close. And then they go, well, maybe I've got another year or two of saving and
Mm.
maybe I want to go get a car loan, right?
Mm.
Is it better or worse? Should they be like, no, let's say put a few $1,000s into fixing the car that you have, right?
Yeah. Yeah.
And get the house first, prioritize the house.
Yeah.
Or if they're a year or two away from getting a house, well, that's a long period of time. Let's get a car loan and we'll get something
Mhm.
that's, $30,000 or $40,000, and that'll be the next car
Mm.
for the next 5 years. We are sort
Mhm.
of trying to avoid business advice because that is something that you
Mhm.
can't really give over a podcast. But in that
Mm.
situation, what would be the kind of good guidelines as general kind of what's the word? Information.
What would someone do? Yeah, so I always say to people that are weighing up buying a home and also wanting to get some form of asset finance is get your borrowing capacity run first. So what we might actually see is that when we run someone's numbers to buy a house, we're going to look at what their income is, what debts they've got, their living expenses, if they've got kids, whatever it might be. Now, somebody might be able to borrow more than enough for the place they're looking at. So adding in a car loan that they might actually need is fine. It's completely fine. And then we might want them to keep the money to go towards the house because we actually, want to buy within a year or whatever it might be. Whereas using that deposit might push it back further, and that was their main goal. So it depends what someone's main goal is. If they're in a position we run their numbers about buying, and if they added any form of debt, they wouldn't be able to buy anywhere near what's actually something that suits them. That's a different story. That's where we're going to weigh it up then and go, oh, well, you might be closer to being able to buy than you realize. So maybe we do that and then you go and get the asset finance. Or like you said, maybe that's when they try and put just a few thousand into the car instead to keep it going for a little bit longer because they want to get to the house. It depends on the priority. But yeah, we see sometimes people are putting off the asset side for whatever reason, business side, car side, whatever it is, because they're focusing on the home, but they don't realize they might be able to actually just do both.
How much, if we can go into home loans a little bit, how much percentage do people really absolutely need to get a house?
It's so hard. There's so many different schemes out there. So if you're a first home buyer, there's a really beautiful scheme. The government released a few things.
It sounds evil when you say schemes. I don't know. There's a scheme. It's what's the guru from Despicable Me has come up with a scheme. Anyway, sorry. I cut your serious train of thought off.
No, you're fine. So there's a scheme in place for first home buyers in Australia where if you're eligible, you can purchase with as little as a 5% deposit. So to put that into perspective, if you want to buy for 600K, let's just say, if you've got 30 grand and you've got enough to cover your purchasing costs, which in some states might not be very much because you are eligible for, stamp duty waivers and certain things, you might not actually need too much money to get into your first home. This scheme, it's called the First Home Guarantee Scheme. It's actually amazing. Like I was saying before, there's some things that are out there that aren't amazing. So there's some that, I won't get into them, but the First Home Guarantee Scheme, you could get in with a 5% deposit and you get competitive rates, save on certain insurances, blah, blah, blah. So that's why I say to people, reach out because you might be able to buy and you've got the money and you didn't even realize.
Right. Especially in this market, people I don't mean especially in this market from a standpoint of that you might be able to buy, but it might be worth reaching out because maybe there's a sort of despair that some young people have right now where they're like, oh, we can't get a home loan ever. Maybe if you've talked to somebody, maybe there is a way. There's an option for that.
There is. And there's so many different types of loans. There's something called a guarantor loan, which is where maybe the bank of mum and dad could help with just by the fact they own property that you could leverage off. There's so many things. With that option, you don't need any money. So people think you might need a 20% deposit to get in. Hence, with your example before, they're saving, they've got 50 grand, they're trying to get up. They might have been able to buy back with 30 grand or 35 or 40 and then still go on and bought the car.
If I had, is there a type of loan that I could get that would prevent? I'm thinking a lot of people get personal vehicle loans. Does that ever, because a business vehicle loan might be seen differently by bank, or do they see them differently? Like a business loan for a vehicle seen differently than me. So me spending $50,000 on a work vehicle is different than me spending $50,000 on a, something that drives through the KFC car park.
Yes. So some banks will exclude business debts, but they won't exclude personal debts. So if you're a sole trader, it's just considered your debt. If you're a company though, and you've got your debts under your company, because we're going off that bottom line of the profit, it's already been taken into account, any of the debts and stuff that you've got. So we can basically ignore them with some lenders. So yes, you are spot on. It can sometimes be better if it's through the business.
So if I was a sole trader, and we go back to that car scenario, and I know you sort of asked this before, but just really clearly, you got your $50,000 car you wanted to get for work, right? And you are thinking you're a couple of years away from getting the house. If I got the car as a sole trader, could that prevent me from, I guess everyone's different, isn't it? But is there a scenario where that might affect it? And is it worth then people going and chatting and double checking that?
Yeah, it can definitely impact it, because if you think of it, when we're looking at how much you can borrow to buy a home, it's basically income in versus income out. So if your mortgage repayment for the house you want to buy is $3,000 a month, but when we take into account everything else, your expenses and whatnot, and now this new car loan you've just gotten where it's $1,000 a month to pay it back. Well, if you needed $3,000 for your mortgage repayment, but you've now only got $2,000 left over a month, the bank's not going to give you that for free. So that's where we're looking at it from. So yeah, it can have an impact, which is why we say if you want to do both, some people don't even have property on their horizon. Totally fine. Everyone's so different. But if they do and you want to weigh it up, check your borrowing first before you go get the debts.
Let's say I had a debt that had 6 months left. I wanted to get a loan, and the market is such that I really wanted to get a house right now. Would I be best off taking some of my deposit and paying off that 6 months in advance, wiping that off? Would sometimes that make it easier to get a loan? Just having the loan off the books, paid, even though you've got less deposit.
Yeah, again, it comes down to your borrowing. So it might need to happen. You might need to close the debt, but that's where we might work on strategies then where you buy the house now, but you do a 4-month settlement. And then by the time settlement's coming up, which is settlement is when you settle on the home, you get the keys, you get to move in. And so you might put your offer in today, secure the home, and then with your finance, we'll say to the bank, we want to get formally approved. A settlement condition is this car loan will be paid out before we settle. So if you've then done a 4-month settlement and you only had 6 months left and you pay your car off 2 days before settlement or whatever it is, you haven't got as much to pay off out of pocket, and it might not cost you. It still can work. So sometimes we plan strategies for timing as well.
If I was starting a business, let's say I'm listening to this podcast, I'm planning to start a business this September, and I'm gone from my nice cushy job that's paying me, let's say, $70,000 a year, and I've got some savings, and I'm happy to take the leap, and I'm going to start my own business. How long would it take for me to be able to get a loan if I've jumped completely from full-time income to all of it being business focused? How does that affect someone's capacity to get that kind of finance?
Yeah, so if you want like home loan, then general rule of thumb is you need to be self-employed for at least 2 years, or your ABN needs to be registered for at least 2 years. So some lenders, we can have 1 year's worth of financials, but they still want to see the ABN's been running for 2 years, just to show there's the stability there. Again, in the property space, there are low doc lenders as well. So you don't need to have been running for 2 years. It might be 12 months, and you can provide less documentation and whatnot, but the interest rates are pretty astronomical. So, and the fees
What sort of rates are we talking about?
I'm going to say, so if you go full doc, just normal, you're probably looking at like 6% rate. And if you're going the low doc space, you're going to be looking around probably the 8. If it's shorter time frame with your ABN, you'd be looking at 8% plus. Some are like 10% interest rate. Yeah.
Right. And
that's for a home.
That 2% doesn't sound like much, but if you did the maths on it,
It's huge,
It's a
yeah.
lot
And we
different.
do have strategies where we'll refinance someone after 12 months away from that lender if we can. But yes, it is a lot more costly. It's not just the rate, though. You have to pay application fees, which are usually like 1 to 1.5% of the loan amount, which can add up. And there's a few things that come into it. From an asset finance point of view, though, 12 months is just stock standard. So if you've been ABN registered for 12 months, that's when you're pretty much open to a lot of lenders in terms of your options. And there's some lenders where if it's 6 months, but the rate will be higher. It's a bit different in asset compared to the resi space.
Let's talk about refinancing. I've never thought about refinancing ever in my life, right?
Yeah.
But what if I was to give you a call and I was like, hey, Cait, I've got, I don't know, I've got a couple of vehicles, I've got a couple of mowers, running some small teams, this hypothetical people. And let's say I'm, I don't know, nice round numbers again. I've got 5 loans. I've got $100,000 total in these loans. So let's say averaging $20,000 each. Obviously, that'd be different for each thing. But let's say that all that sort of happens. And let's say I've had those loans for 2 years or whatever like that, and it's just not crossing my mind. Is it really worth it to go and keep price shopping and refinancing for that kind of scenario for a small business?
100%. That is, and this isn't just because I'm a broker, I'm not just saying this. This is with any broker or your bank or anything. I mean, I do say use a broker over a bank because a broker obviously has, that's the whole point. We have the option of many lenders rather than banks, obviously the one. But that is our job. So I say to clients all the time, come to us. We will have a look at what you've got. And we will look at it and either go, we'll know pretty much straight away, okay, what you've got in terms of your rates and everything is actually really good. Like stay where you are. Or there's other times we'll look at it and go, you can actually refinance your equipment or your assets or whatever it is that you're holding. And what you're on is actually like astronomical. So that's our job. So we'll put together the quotes and everything and show you. It costs you guys, well, it shouldn't cost, if depends on the broker, I guess, but anything. It's part of our job. So I always say, why wouldn't you? You should check it. From like the home loan space, we'll automatically review clients' rates every 6 months in case they've jumped and whatnot, and we'll apply for discounts with the rates and everything too. So it's the same in all areas. Don't get comfy because banks will always be more favorable to new to bank customers because they want to get you in the door rather than bank loyalty tax is a real thing. It can end up costing you more staying with a certain lender sometimes.
Yeah, it's a bit weird, isn't it? You would expect it to be the other way around. You'd be like, oh, we've been with you for 30 years. Let's, we'll give you a really good rate. And they're like, these people don't change. And we know that. So we'll stick it to them.
Yeah, it's true. But we also going to cash flow lending. We have even last week for a client, they had a trailer, a very expensive trailer, but they had a trailer and it was about 170 grand. And originally they'd used cash to buy it, but they
gold encrusted labor works with the welding and the diamonds. And how did they get? What sort of business is this for?
It was
lined with cocaine. Sorry, this is getting out of hand.
It was like for a truck. It was a big one for a truck, whatever that is.
Oh yeah, okay, anyway. Right. Yeah, no, of course,
not
a truck
like
trailer. Yeah,
behind a
they're
car.
expensive. I'm still thinking lawn mowing businesses. Like, who can spend that much? Okay, yeah, that makes sense. Continue.
Cash flow lending, though, and this applies to any business. Sometimes people pay for things with cash, but they want the cash. You can go and get that equipment piece financed. So you might have something you paid 30 grand for a mower, but now you're like, I wish I'd gotten that on finance. I need that 30 grand cash. You can then go and still get that on finance in most cases.
Oh, really?
Well, in some cases. Yeah. So cash flow businesses. So you saying a business is struggling before, maybe they just need that cash boost to apply the money other areas of their business to help it grow or pay staff or whatever it might be. And they might have equipment they can get finance on that they've already paid for.
So can I just go to all my equipment that I've got paid off and just be like,
hey, can I just wrap up
and combine them all together? And then again, KFC drive-through. But is that possible? I mean, I'm being silly here, but let's say somebody did have a lot of little pieces that maybe a couple of $1,000s each. Little as I'm not talking about a $50 rake, but let's say you've got a couple of mowers and a few thousand of this and that, whatever, and you found yourself in a really hard spot. Could you do it over multiple items, or is it really just the big expensive items that you can do it over?
No, You can do it over smaller ones. It probably does depend on how old and ragged and whatnot, and do you still have an invoice and blah blah blah. But you can with most things. Or there's also lending like line of credit. A line of credit, if anyone hasn't heard of it, is like a giant credit card. So let's say it's for 50K, a line of credit, a bank approves you. You only make payments back on what you've used. So if you've only used 10 of your 50K, you're only paying the bank interest on your 10. The rest of that 40 that's sitting in the bank account, you don't have to make repayments on. So sometimes businesses need that to keep them going for a little bit to get back on top or whatever it is. There's a million types of loans. It's just about making sure it's right.
I do guess that if you're at a position where you are having to get a loan off small items to cash flow someone's
Correct.
payroll, you've probably gone too far down the problem path. That's, having said that though, we have had times where major contracts haven't paid, and there's huge amounts of money. So I can imagine with a cash flow issue where you're actually profitable on paper, it's just people aren't paying. Okay, I can see that.
Yeah, it happens.
It does happen. It's a pain in the butt when it does. I've never been to that stage where you couldn't pay payroll, but tens of thousands of dollars before. Anyways, but moving on from that, we have had moments where, I guess at that stage, really the conversations really should be having on an accountant level and a business advisor and financial planner level.
Yeah.
The broker is probably papering over some cracks there.
Yes. Yeah.
So, look, we're at the hour mark already. That time has flown. What? Oh no, it's good. This is people say that.
Says.
People say that, but it's like, well, what's exactly what podcasts are for?
That's very true.
I can't complain on the kettle calling the pot black. If we is there anything for small businesses that we haven't covered right now that is super really important that small business owners should know?
I think the biggest thing is it feels like it's always spread out there that if you are self-employed, you can't get finance. And it's just not true. It's just about the strategy that goes with it, which is really important. And it's about, what steps you need to put in place, which we've covered. It could be credit scores. It could be, speaking to your accountant, whatever it might be. If you're also potentially thinking about getting finance, especially as we're just in a new tax year, same thing, maybe speak to a broker first before getting your tax done. So there's certain ways that you can work as a team too. But no, I think not saying do dodgies, everyone that's listening, but just having the right people in your corner. But don't think because you're self-employed you can't get finance. And there are a million different types of finance. It could be cash flow lending, it could be overdrafts, it could be equipment finance, home loans, commercial. We had someone recently that was renting out a factory for all their equipment, and was like, well, why don't you buy the factory? Like, you're paying the rent for the mortgage. They had a deposit that they could, and there's certain types of, so there's so many things out there that they might completely change someone's strategy. So just speak to a broker.
There you go. And where do people find you?
Well, my embarrassing Instagram is Craving a Saving. And then my slightly more professional, my business is Inspire Home and Asset Loans. So you can find me on those, or lawnsingoodnickswife Instagram, which is arguably the best one.
Oh, it's the most fun. But they're all fun. And I like that. I do like that you're in finance and you are the I think you're the silliest person I follow on Instagram. I think.
Look, I'm a bit weird. I do say that to everyone, that I'm a bit weird, but that's okay. Just accept me for who I am.
No, you do. And having said that, I have had this laptop. I'll tell you about the caravan park now. Right?
Yeah, go. Tell me. I'm scared.
We drove from Adelaide to Mount Gambier yesterday. We got in when it was dark. And my wife pulls up, and she had told me, she said, this caravan park, it looks like it's got a bit of charm to it, as a positive. But she was like, oh, but, we're looking for a certain type of room that has the kids off to the side, because we're not caravanning, we're staying in cabins, and we want the cooking facilities. And so she's picked this spot. We rock up at night, can't see a thing. right? And they're like, oh, we got you this room. And Kara's like, oh, actually, I specifically asked for this type of room. And they were like, oh, okay. And I was like, all right. And we realized that no one's opened the doors to these rooms forever, right?
Oh, no.
We walk in, it stinks, right? And we're like, okay, look, it's a place to stay. All right, okay, don't whinge too much. Turn on the water. It's a little bit brown. No one's turned on this water. It cleans out a little quickly, right? Like, okay, all right. It's freezing cold. It got to 0 last night, right? And so we've turned on the
Oh,
heater,
yeah.
and it is like an old man is breathing on you, you know? And its heater is so old, right? The fridge door was left open because I didn't want to get moldy. That's how long it's been since anyone's been in this room. The
Wow.
guardrails on the buckets are
Oh,
wobbly, all that sort of stuff. Anyways, and then we drive out to Carrie has to go. Literally, KFC made it into the story. KFC is like 2 doors down.
around the corner. That's why
And
you
like,
went
we
there.
just got to get something warm, and then Carrie's driving through his potholes and everything. And anyway, this morning I'm walking around like, what scenic part can I have this caravan park? Beautiful trees, beautiful grass, I must say,
Yeah.
to give it its
Yeah.
credit. But I just think what happened last night, because there are some nicer cabins here, I think they booked out all the nicer ones. They put us in the wrong one, and this is the dingy one no one has ever been in forever. The water was barely warm. The old man aircon just heated enough that we survived the night. But anyways, I've done this
It does
entire
look
podcast.
nice behind you.
Oh, behind us, outside is nice. Outside is nice. And
Yeah.
to give them the credit, I think there are some newer cabins literally on the other side that look okay.
There is. Yeah.
But
That looks good.
I have to say, I will take this off and I'll show you that this entire podcast has been done. For those people who made it to the end, what a bin.
A bin.
I had my laptop sitting on a recycling bin because I couldn't find a table.
I love that. Hey, you've got to do what you've got to do in business. And if that ain't the final lesson for this episode, then I don't know what else is.
You got to do what you got to do. And I was pointing that out because that's the real world sometimes. And I like that your Instagram is the real world of you, unless you're faking it. You know, you can fake the fact
what
that
you get is what you see is what you get, for sure.
I think that was a really good jam-packed hour and roughly 6 minutes. Thank you so much for coming on. And do you know what? I'm going to ask people that if you're on Spotify, Apple, YouTube, and you have more questions that I didn't ask, type them in the comments, and maybe one day we'll get Cait, better known as lawnsingoodnickswife, on the podcast again, and we can go through those because I reckon she's got a wealth of knowledge that I clearly don't have. Thank you for coming on, Cait.
Thank you. Thanks for having me. Appreciate it.
We appreciate it too, and we'll see you all in the next podcast. Done.